I feel like some of these rules that we talk about, an inverted yield curve, and I think most recently it's about the triggering of the SARM rule, right? So if unemployment rises by a certain amount of its recent low, then that means we're already in a recession. It just reminds me of a saying that rules are maybe made to be broken. I think as far as the inverted yield curve goes, it's been about as useful as a recession predictor as a wet paper bag, not because it doesn't precede a recession, but the lag between when a yield curve first inverts and when a recession actually happens is so variable that, how does this help you to position as an investor? Really, that's more what I'm getting at. I do think it's more important to pay attention to recent data and the momentum of that data. So here's what I think we know. We know that the US economy is softening, right? It's weakening, but it's not weak. The direction of travel is good for if you want interest rates to come down off their currently restrictive levels. But the level of activity is certainly not yet at a point where we need to, run for the hills and get really defensive in all of our portfolios. But what I do also bear in the back of my mind is a year ago, this wasn't the case. We were talking about recessions, but the data was not softening. Now that the data is softening, we can argue about whether it's a soft landing or a hard landing, but purely because the momentum is softening, it just naturally increases the probability that the softening will eventually end in a harder landing than what most are expecting, and especially what analysts' earnings expectations for the S&P 500 over the next 12 months seem to be expecting.
What are the conditions that the market needs to see in order for the Treasury yields to revert? So we have the inversion. How would it go back?
So here, I'm going to first of all just go with a traditional bull market steepening for treasuries. So typically this is how it would go at the end of a cycle. The curve starts to invert because the bond market thinks that the interest rates that are quite elevated today can't be sustained into the future, and along the way, some kind of softening is going to cause the Fed to slash rates. Then the curve normalizes because the Fed decides, oh yes, the economy is soft enough that we need to slash rates, and then the curve normalizes. For that to happen now, though, for the degree of inversion that you've been seeing in the economy, you have to get a much softer economic picture than what is currently in front of us. The Fed is still guiding to 3 cuts, two or three cuts. The market's definitely asking for more than that, including the possibility of a 50 basis point cut in September. And the data's just not saying that that's warranted. We were even talking about emergency cuts a couple of weeks ago. And I looked around and I said, what's the emergency?